What's up guys, Rick here, and today we're gonna compare two ETFs that grew over 45% this year and include the best performing companies of the last decade. I'm talking about VGT, the Information Technology ETF by Vanguard, and QQQ, the Invesco QQQ Trust Series 1 ETF, which is the fifth ETF in the world per assets under management and embraces the whole growth sector. Both of these ETFs have outperformed the S&P 500 index both in the short and in the long term. So today we're gonna discuss which one of these ETFs is a better buy. And even if you are instead a value investor or a dividend investor, I still believe that this video is for you because both VGT and QQQ can optimally balance your value investments. So for this comparison, I'm gonna grade 6 different aspects of the ETFs, and at the end of the video, I will also tell you exactly what would be my approach in choosing between VGT and QQQ. So now let's get right to the first aspect, which is the strategy. VGT is one of the most diverse market cap weighted tech ETFs. It gives wonderful coverage of the whole tech industry, tracking an index made up of stocks of large, mid-sized, and small US companies. Inside you find companies in basically 3 areas. Companies that sell technology services like Adobe or Cisco systems, manufacturers of equipment such as phones or computers like Apple and Microsoft, and also semiconductor companies like Nvidia. The fund's prospectus doesn't say much about the strategy used to choose the companies, but considering that you have 318 companies within the ETF, you can say that there is a high level of diversification within such a profitable sector. On the other hand, there is QQQ, which follows the top 100 market cap weighted non-financial companies which make up the NASDAQ 100 index. You probably know QQQ as the most famous growth index. In fact, it's been rated a #1 best performing large cap growth fund on the market based on the returns of the last 15 years. And what is the strongest sector in this index? Information technology, of course. When it comes to strategy, although VGT is totally weighted on the best sector of the stock market, QQQ uses a more diversified strategy by grasping more sectors, and this reduces volatility a little bit. Since the screening criteria are not incredibly sophisticated in both, I'm gonna give here 7 points to VGT and 8 points to QQQ. The second aspect is the expense ratio, which is usually underestimated by many small investors, but it does have a strong effect on your long-term profit. So when it comes to expense ratio, VGT is a clear winner with an extremely low expense ratio of 0.1%, against 0.2% of QQQ. If you'd like the same returns with a cheaper expense ratio, you can go with Invesco QQQM, which is the same as QQQ but with a 0.15% expense ratio. So let me guess. Some of you now are wondering, why aren't we just analyzing QQQM if it's really identical to QQQ? Well, QQQM is younger than QQQ, and so while QQQ has over 220 billions in assets under management, QQQM still has around 17. This translates into less liquidity and potentially more spread between buy price and sell price. Now, if you ask me, I wouldn't really see 15 billions as a problem, so I would go for QQQM. So it might not sound like a lot, but double as much expense ratio does impact heavily your net worth. So I'm gonna give 9 points to VGT and 6 points to QQQ, making VGT the leader with 16 points and QQQ following with 14. The next aspect we're gonna see is the risk of these ETFs. There are basically 4 kinds of risks you can have. The first one is the stock market risk, basically the chance that the whole stock market crashes. Stock markets tend to move in cycles, just as the economy, so there is little you can do about this if you're a long-term investor. The second is the sector risk, which is the chance that something happens to a single sector. Since VGT tracks the information technology sector, obviously the fund's performance depends, for better or for worse, only on this sector. QQQ instead also has an overweight in technology but covers all sectors except finance. The third risk is the so-called non-diversification risk, which is the chance that the fund's performance might be hurt disproportionately by the poor performance of a few or a single stock. We're going to talk about this in the next part of this video, so I'm going to skip it now. The fourth and the last risk is the investment style risk that depends on which segments of the stock market are included in the ETF. Some of you know the investment style box, which shows if an ETF invests more in growth or value, small or large companies, and so on. Well, QQQ is focused on large growth companies from the NASDAQ 100, while VGT, although focused on only one growth sector, embraces also a part of mid and small cap companies. So when it comes to this, VGT shows less risks. As you can see, it's hard to find a winner when it comes to risks. So let's try using a risk-adjusted ratio like the Sharpe ratio that measures the performance of an investment, adjusting it by the risk. So basically, the greater a portfolio Sharpe ratio, the better its risk-adjusted performance. If we use the website portfolioslab.com to compare it to ETFs, we find that they've had pretty similar Sharpe ratios all along, and in particular VGT, the orange line, had a higher Sharpe ratio in periods of bull markets right before the bear market. And it's because before a crash, usually the technology sector is the one that tends to outperform. In the last year, they've been more similar, with QQQ having a higher Sharpe ratio since August. Nevertheless, I'm going to have to give 6 points to both for being quite volatile ETFs. So now we have 22 points for VGT and 20 points for QQQ. Point number 4 is diversification, which in some way also tells us something about the risks. To find out how diversified the ETFs are, we need to see the number of stocks, the number of sectors, and above all, how heavy the ETFs are invested in particular stocks. Because if those stocks go bad, the ETF is also going to be affected. VGT contains 318 different companies, while QQQ only 102. In addition to that, VGT has 76% on large cap stocks and 24% on medium and small ones, which in my opinion is a strong advantage because in the last 30 years, since 1994, mid cap and small cap have both outperformed large cap stocks with an average annual return of 11.7% and 10.78% respectively, against 9.67% of large cap. But QQQ, and here's the important point, QQQ diversifies within all the sectors except financials, while VGT only invests in information technology. Obviously, this gives an edge to QQQ because a bad year for a sector can be balanced by a good year by another. While if information technology has a crash one year, there is nothing mitigating the damage in VGT. And in addition to this, VGT is extremely concentrated on a couple of companies. Check this out. VGT has over 40% on Apple and Microsoft alone, 40% on 2 single stocks. QQQ instead has around 21% on them combined. And as much as I love Apple and Microsoft and I have them in my portfolio, when it comes to diversification, this is surely a negative point for VGT. So I'm gonna have to give here 5 points to VGT and 7 points to QQQ, bringing both ETFs to a total of 27 points. Point number 5 are the holdings. VGT, as we've seen, has Apple, Microsoft, Nvidia, Broadcom, Adobe, and so on, with a total weight of the first 10 holdings of around 60%. QQQ is also heavy on tech, but it also gives exposure to consumer discretionary with companies like Amazon and Tesla, as well as communication companies like Meta and Google. So without going into more details on the holdings, I like the fact that with QQQ I'm getting not only Apple, Microsoft or Nvidia, but also these other great companies that I believe belong in everybody's portfolio. For this reason, I'm gonna give 7 points to VGT and 9 points to QQQ, bringing VGT to a total of 34 points and QQQ to 36. All right, let's jump to the last and probably most important aspect, which is performance. Obviously, past performance is never a guarantee of future results, but by seeing the last 10, 15 years, we can still get an idea of how both ETFs performed during the long bull markets and also during the crash of the past few years. So in the last 10 years, VGT returned 504%, turning a $10,000 investment 10 years ago into over $60,000 today. This translates into an average annual return of 19.72% per year. QQQ instead grew 399% in 10 years, translating into 17.44% per year on average, which is such a huge number that it's even funny that I have to say it wouldn't have been your best investment in the last 10 years. In fact, you would have around $50,000 in your pocket instead of $60,000. Looking at the 5 years, the number gets even crazier. 21.7% per year on average for VGT, which is nothing less than Buffett's level, and 18.87% for QQQ, giving a total return of 167% and 138% respectively in just 5 years. Now, if we look instead at the behavior of the two ETFs from the beginning of 2022 to today, we can see how they reacted to the crash in 2022 and also to the rise in 2023. Surprisingly, VGT saw a smaller decrease during the crisis despite being focused on just one volatile sector. One reason might be that VGT has double as much weight on Apple and Microsoft compared to QQQ, which was a disadvantage early in the video, but also means that if these two companies stay strong, the drop in price of the ETF is also going to be reduced. But now let's try not to focus on the last 10 years because both VGT and QQQ has been around for more than 15 years. I find it really interesting that QQQ outperformed VGT right after the 2008 crisis, while VGT started outperforming after 2016 when the bull market got serious. And in the end, they both had a really similar final result with an average annual return of 13.66% for QQQ and 13.81% for VGT. So what can we deduct from all of this? VGT wins in regards to total performance, although not by a long shot. QQQ, though, has many companies that are not in VGT, such as Amazon, Google, Tesla, and Meta. And since past performance is not a guarantee of future results, we ask ourselves what is actually going to happen with the technology sector in the next decade. So I'm going to tell you how I think you should approach this investment choice and what I think about the technology sector, but before this, let me give you 10 points to VGT, which are well deserved for the past performance, and 9 points to QQQ, making QQQ the winner with 45 total points against 44 of VGT. So, which ETF is really the best for you and how should you approach investing in growth stocks? This is the most important part of the video because there is one mistake that I see so many people making investing, and I hope you won't make it. The first thing that we should all remember is that even 10-year results can be misleading. Growth and value companies have been outperforming each other in different decades, and of course, technology is the strongest sector, and probably in the future it will be the one that in the long run delivers the best results. But the fact that in the last 10 years this sector gave close to 20% per year should actually scare us more than make us happy. While in the short term, stock prices are moved by emotions, in the long term they tend to align with the real finances of the companies. And all these companies, even great ones like Apple and Microsoft, didn't grow their revenue and earnings by 20% per year. In fact, it was more like 8-9% on average. We can also look at the so-called PE ratio, and this is also going to tell us how the whole technology sector is overpriced. The PE ratio, in case you don't know, is a value that tells you how pricey the stock is compared to the earnings of the company. Apple's PE ratio has been excessively high in the last years, signaling that the price of the stock has grown twice as fast as the real earnings of the company. This means, in other words, that more and more of the stock price is now made of expectations that we have of the company's future rather than real results of the company, which is like playing with fire because already the fact that the earnings are not growing as fast is a sign that the expectation might be exaggerated. Same for Microsoft, with stock price growing more than earnings for over 10 years. And these companies not only represent 40% of VGT, so their drop would mean a huge decrease in the ETF, but they also represent a reference for the whole technology sector. So if their price were to be scaled back, we would also see a reduction in price in all other companies because investing communities would panic on the overall tech sector. And now let me show you Nvidia, which was one of the greatest winners of 2023 and has a huge weight in VGT. Nvidia has a price to earning ratio over 100, up from around 10 in 2012. So in 10 years, the price of Nvidia stock grew 10 times more than their earnings, and today if you bought a share of Nvidia, you would pay a price that is over 100 times the amount of earnings that the share represents. Given all these circumstances, I can only advise you to be really careful with the optimism on technology. Or I shouldn't say advise you because I'm not a financial advisor and I know nothing about investing. But the truth is, it's always easy to grow a lot of optimism for a sector only because it performed great in the last 10 years. And what we do is we project that optimism in the future until one day the bad surprise comes. So to protect yourself from this, since none of us is Warren Buffett, consider diversifying with value ETFs like VTV, SHD or VIG, even if they didn't perform as well as VGT. Or just invest in something like the S&P 500 or the tallest stock market, for example through VO or VTI. And if you have to choose between VGT and QQQ, you need to know how ready you are to take risks, but for sure you shouldn't invest too much of your portfolio in just these two ETFs. I don't know if you agree with me or not. In both cases, let us know in the comment section below what you think about it. And of course, if you enjoyed this video, don't forget to subscribe to the channel for more videos like this. Thank you all for watching, guys. I wish you a great day, and as always, I'll see you in the next video. Ciao!